Alright guys, in this video I'm going to show you guys why your portfolio is underperforming. Why are you not outperforming the S&P 500? Why do your returns seem very small? I am going to cover these topics in this video. So we all know the situation that we bought a stock at a price level that we thought is quite attractive for that stock. It doesn't matter if we bought it with a cash secured put or if we just went out and bought shares at the market price. Right here, I have an example for you guys, American Airlines. So if we speak about this specific stock, we can see right here that an investor who bought the stock in 2021 would be sitting at exactly the same price right now in 2026. Meaning for the last 5 years, this investor made absolutely no gain. So it seems quite bad. So the first intuition to say here is this situation seems quite bad because you invested your money 5 years ago and 5 years later you made absolutely no return. The stock is trading at the exact same price. So what usually happens is any normal retail investor who bought the stock right here and then they see the stock going down and going down a little bit and they are in the minus 1 to 2 years later, eventually they will give up on the position and say, okay, this position failed, I am going to sell this position and I'm going to realize a loss. But what we don't take into consideration and what many retail investors don't do, they don't use covered calls, because this stock can be seen as the perfect stock from a different perspective, because a retail investor who is holding American Airlines since 2021 had the chance for 5 years to continuously sell covered calls on this position. So a covered call retail investor goes ahead and says, okay, this stock seems like it's having some resistance levels somewhere up here around $19 to $20. And you continuously sell covered calls to the upside, where you commit to possibly sell your 100 shares at the upside. And for this commitment, you are going to be paid a premium by the market. All right, because you commit yourself to possibly sell your shares, you need at least 100 shares. So options always come in a 100 pack, meaning you need at least 100 shares to sell one covered call. You guys can do the math. If you have 200 shares, you can sell 2 covered calls on this position. I think you guys understand the math here. And this is quite interesting because for 5 years, you can collect a premium every single month where you're selling a covered call to possibly sell your shares at an even higher strike price. And we can see that you would have kept your shares because the stock is literally not rising above your strike price. So you would have massively outperformed a retail investor who either way sold their stock in the minus and realized the loss, or who basically did nothing and was just holding the stock, absolutely generating no income. So you would have definitely outperformed these two different types of retail investors. So this is a great example that shows you guys that you need to have an advanced understanding of how you can generate a passive income from your portfolio. And if you're interested in my strategy, the premium cycle, if you want to generate a safe passive monthly income, then click the link in my bio, check out my free course about the premium cycle, and I will see you guys there.